Welcome back, everybody. Thanks for being here at the NARPM podcast. I have my good buddy, Chris Picciurro. Did I say it right, Chris? I always say your name. Do I say you? Is it Picciurro or
Picciurro, but Pete, I've been
Picciurro?
called a lot worse.
I'm sure you have. So Chris Picciurro with Teaching Tax Flow. Chris has been a good buddy of mine, actually has done my taxes over the last few years. And so I do appreciate that. And he's done taxes for lots of NARPM members. And Chris, you spent over 20 plus years working extensively with real estate investors and entrepreneurs. And so I'm going to get right into it. What are some of the tax implications based on some of the different entity structures? Is one better than the other?
Well, first of all, thank you very much for having me on. I appreciate it. Hello, NARPM. Hopefully, many of you I've met before, and if not, thanks for tuning in. And when we talk about entity structure, what our goal is to legally and ethically reduce the tax you pay in your lifetime. And one of the things that we have to consider, and one misconception, is that not all income is taxed the same. So you might receive $100,000 worth of income, and depending on what type of entity you have, you could be taxed differently on that income. So if we want to start off from the most basic structure, would be a sole proprietor. A sole proprietor is going to, let's assume they have $100,000 of income after all deductions. They're going to pay tax on that, a federal tax. If they're unlucky enough to live in a state with a state tax, they're going to pay tax on that. And then they're going to pay what's called self-employment tax, which is goes into the Social Security and Medicare fund. If you create, I think you mentioned an LLC. So an LLC stands for Limited Liability Company. If I had $1 every time I heard Limited Liability Corporation, I don't know, Pete, I might not be on this podcast. I might just be
in the Bahamas sipping Mai Tais. I get
it. So if you form an LLC, we like to call it LLC, it's like a Play-Doh entity. But a single member LLC, one of the biggest misconceptions out there is that about single member LLCs. So a single member LLC for federal tax purposes is a disregarded entity. That means it's taxed exactly the same as a sole proprietor. You don't receive any additional tax deductions just for forming an LLC. You also don't miss out on tax deductions if you don't form an LLC. So think about that sole proprietor and single member LLC as one and the same. So you're going to pay tax. Advantage of starting a business or owning a rental property is that you pay tax on your net income, not your gross income, like someone that receives a W-2. So single member LLC, same as a sole proprietor. The difference is that they receive liability protection or asset protection. Again, I'm not an attorney, so I want to put that caveat out there, but that's the advantage of forming that LLC. With a multi-member LLC, that means you have more than one person coming together, and they are what are called members of the LLC. A multi-member LLC is taxed by default as a partnership for federal tax purposes. So one thing to consider is that if you're a multi-member LLC, a single member LLC, or self-employed, let's take self-employed out of it. If you form an LLC from a federal tax perspective, either single member or multi-member, the LLC from a federal tax perspective is not taxed. The profit and loss from the LLC flows onto your personal tax return. So there's no real tax advantage to that. I'm sorry?
Is that in the form of a K-1 statement, Chris?
Yes. So K-1 is a form that's attached to a multi-member LLC.
Do you get one if you're a single member LLC, or no? You don't generate one for single member LLC?
Correct, but you do not generate a K-1 for a single member LLC. Since it's a disregarded entity, if a single member LLC owns a business, it gets reported on Schedule C. If it owns rental property, it gets reported on Schedule E of your personal return. Now, there's a caveat, which is a good bridge to jump over, to the S corporation.
Okay.
So what happened is, well, let's step away from the S corp for a moment. We have a good handle on LLCs, and depending on, we're going to talk from a federal tax level because different states have different franchise and excise taxes. The LLCs make a lot of sense because they're pretty simple, especially with if you own a business, and especially if you're a single member LLC. If you're a multi-member LLC that owns rental property, well, net rental income is taxed completely differently than if you are an active in property management.
Right. Okay.
Because it's passive income. So I'm going to move over to a C corporation.
Before you do that, quick question. When you have an LLC, a lot of times the form will ask you, like, how is this going to be? Is this going to be an S Corp LLC, a C Corp LLC, or a partnership LLC? Is there any main difference on what I select for that on the EIN form?
So and that's a great question. When you file that EIN, you're going to want to put what you think your anticipated entity type is going to be. Your entity type is really figured out when you file that first tax return. So from a single member LLC, multi-member LLC, either one of those, multi-member LLC's taxed as a partnership, then again, the profit and loss just flows to your personal tax return. So if you're forming an LLC, single member LLC is going to be a disregarded entity.
It's a pass-through, yeah.
It's a pass-through. Multi-members. The nice part about a multi-member LLC, not to go from advanced or to basic, from basic to advanced, with a multi-member LLC, it does allow you some more flexibility when you're shifting income between members. So let's say, Pete, you and I form an LLC. You're drinking the Mai Tais. You own 50% and I own 50%, but I'm out doing all the work. I can take 80% of the profit, but you still own 50% of the LLC. So that multi-member LLC gives us flexibility. Now that flexibility and how the profit and loss are allocated and the ownership percentages that's all determined in what's called an operating agreement.
And that's where we'll let the attorneys kind of answer it from there. But so let's talk about C Corp and S Corp.
Absolutely. So a C corporation, if you form a corporation based on the federal tax laws the way they are right now, that corporation is an entity separate from yourself and it's taxed separately than yourself. So the profit from the corporation doesn't flow on your personal tax return. A C Corp does not issue a K-1 to its owners. The C Corp, though, is going to pay a tax of 21% on the federal level on whatever net income is retained into the C Corp. And that's why you're going to hear people say, well, you're double taxed on that income. Because if a C Corp has a profit of $20,000 and pays you a dividend of $20,000, the C Corp doesn't receive a deduction for that dividend and you're paying tax on that dividend. So a C Corporation, they're not very popular anymore. The reason you would, there's reasons you would be a C corporation. There's some advantages coming, be it you want a fiscal year end, or you want to really control the amount of income that flows on your personal return. So there are some reasons to be a C corporation, but they're pretty rare now with the birth of S corporations, which is a good segue to our last one we're going to talk about. When you think about an S corporation, these are, S almost stands for sexy, because I can't tell you how many times people say, oh, should I be an S corp? Oh gosh, the S corporation is a hybrid entity. So if a C corporation and a multi-member or single member LLC had a baby, it would be an S corporation.
Okay.
So the S corporation has some attributes of a corp, but it also has attributes of a partnership because the profit flows onto a K-1. Goes on a K-1.
Okay.
The S corporation is an election that you make. So you don't necessarily form an S corporation. You either form an LLC or you form a C corp. In either one of those options, you can then elect to be taxed as an S corporation. So an S corp is a tax election that you make to be taxed as this hybrid entity. Now, I think you asked which one is best. And every CPA is going to say it depends.
Right.
But here's the situation with the S corp. The biggest tax advantage of an S corp is that profits, after you pay yourself what's called a reasonable salary, so reasonable compensation, those profits are not subject to that 15.3% self-employment tax. So let me give you that example of $100,000. You have $100,000 worth of profit. Let's say you're single. You're going to pay tax on that $100,000, your federal tax and self-employment tax. If the S corp has $100,000 worth of profit, it has to pay the owner what's called a reasonable compensation. So let's say it pays the owner $40,000 of reasonable compensation on a W-2. That $40,000 on a W-2, well, that's going to be subject to payroll taxes, which is the same as a self-employment tax. The $60,000 of remaining profit is not subject to self-employment tax of 15%, 15.3%. So in that fact pattern, there's a potential $9,000 tax savings by being an S Corp.
So would I take that money as a distribution then? That extra 60?
Absolutely. You could take it as a distribution.
Okay.
Now, when you have me back on the podcast in the future, which I just determined threw out there now, we can start talking about.
You get me pick.
Well, don't show any pictures of me then. But we can start diving into these entities in more detail, and we're going to talk about that in a little bit. But there are rules. So with an S corporation, you do have to pay yourself what's called a reasonable salary, and we have, in our private practice and a lot of other CPAs, we have tools to allow you to figure out what reasonable compensation is. And the S Corp doesn't always make the most sense. It really depends on what your profit is, what you can legally and ethically pay yourself as reasonable compensation, and what your total picture is. Because with the Tax Cuts and Jobs Act of 2017 and the birth of what's called the qualified business income deduction, some people call it the Section 199A deduction, that 20% deduction is a lot less for an S Corp because you're getting it on the net income versus someone that's self-employed. And then you also have compliance costs. Now you have to pay yourself. You're technically an employee of your own corp. So there's a lot of different things to consider. The one thing I do want to point out, since this is our friends at NARPM's podcast, it's extremely disadvantageous, I guess you could say, to put real estate in an S Corp 99.999% of the time. So what we like to usually see is, let's say you have a profitable property management practice. We see a lot of them that are S Corps, and then you might buy an office building in a separate LLC and lease that to the S Corp. And the S Corp could be an LLC. What happens a lot of times is, as a client grows in profits, the LLC sometimes grows to a point where the S Corp election then makes sense. We have to make sure the juice is worth the squeeze.
So if I hear you right, in most cases, when you're starting out, you should create some kind of LLC. Hopefully it's a multi-member, which you might get some tax benefits from that. And then as you grow over time, as you're talking to your tax strategist, and we're going to talk about teaching tax flow here in a second, as you talk to your tax strategist, there might be a time when it makes it the right move to create the election of the LLC to be taxed as an S Corp. Did I get that right?
Correct. I would, if I'm getting started, I would form an LLC. If you're the only member, you could be that single member LLC. But like you alluded to, if you have a business partner, do the multi-member LLC. And typically you're going to want to see how it goes before you make that S corporation election. Because the S Corp, there's a lot more compliance, and there are a lot more accounting considerations with that. So, yep.
All right. So go ahead. You had another point?
No, one thing to consider with the S Corp is this. You have, once the LLC or the corporation is formed, you have 75 days from that point to elect to be taxed as an S Corp. And you have 75 days into any year to choose to be elected to an S Corp. So let's say you and I had this multi-member LLC and we decide we're going to be an S Corp in 2023. We actually have until March 15th, assuming it's not a leap year, which I don't know if it is, but we have till March 15th of 2023 to claim to be taxed as an S Corp, retroactive to January 1st. Correct. Yeah. Okay.
Oh, January 1st of that same year. So okay. I got it, but not for 2022. That after March 15th, I'm taxed as whatever I elected at that time. But
yes, the ship has sailed. Now there are, not to get into some other crazy stuff, but there are some revenue procedures and there's some relief for late filing, S Corp filing election. But in general, you are what you are for that previous year.
So Chris, you and I go back. We've probably known each other for close to 10 years now, since I joined NARPM and you joined NARPM. And we're business friends, and we're friends now. We kind of went over that line, and we're like friends now. And you and I speak quite often.
Mhm.
And a lot of times we're speaking about my tax situation, right? So you were literally, I'm using your services and you're coaching me. A lot of times I call you to like just kind of talk to you about the Tennessee Titans, but then of course I always throw in like 2 or 3 questions on business, and you're very gracious with your time. But most people don't have that. So you created the teaching tax flow. So tell the our audience, like, what was the inspiration behind the teaching tax flow, and what exactly is the teaching tax flow, and how can property managers and investors utilize that service?
Right, right. And I guess depending on how the Titans are doing, it depends on when I have to transition to your taxes. So,
Yeah, lately it's pretty quick. Lately, it's
yes,
pretty quick.
it was. So here's teaching tax flow is a passion project for me. To take a step back, you're right. I started off over 20 years ago, really focusing on growing a CPA practice, but I built the practice based on me running it and not processes. And 12 years into it, I looked around and I saw that we had over 25 team members, 7 permanent or seasonal offices, over 3,000 clients. And what seems like a dream was really just a nightmare. I have 2 teenage children and a child that's 9 years old right now. Honestly, my oldest 2 children, the first 5 years of their life is a complete blur, and I feel a lot of guilt and regret about that. So I thought, okay, though this is silly. I want to only focus. So the last decade now is I'm only going to focus on real estate people, entrepreneurs, and I'm only going to do this on a membership-based subscription business model that focuses on tax planning and strategy. That's it. And so basically went through that process of transitioning over 90% of the clients, and I was basically reborn, right? I hit reset. And from that, we were able to build a private CPA practice to the point where we have ceased taking on new members to our private CPA practice. That being said, what was born from it is something beautiful, a process and a system for tax planning and strategy. And what I realized is that there's a huge need and there's a huge gap of people that don't have access to tax planning and strategies because they've been lied to. And it's not their fault.
Their own CPA, right? A lot of CPAs don't understand tax planning and strategy. They just understand how to do your straight taxes, right?
Right. And that's one of our laws of teaching tax flow is your tax return's a verb, not a noun. So at the heart of it, I love to educate and I love to help people. So I thought, okay, this proprietary process that we've created named Teaching Tax Flow, I wanted to get this out there so that other people can enjoy it. And what Teaching Tax Flow is, it's the process that empowers you to defeat taxes. And it's built to complement and not replace tax preparation. That's what it is. And
so when we were in the green room, you talked about there's like a 4-step process about tax planning, regardless of using teaching tax flow or not. So talk about that and how teaching tax flow helps you walk through that process.
Exactly. And with teaching tax flow, so I started thinking, Pete, okay, over the last decade, why have our techniques, which you might or may not be familiar with some of them, work so well? And I thought I have to, instead of making that mistake of me running it, let's create the process to run it. And the process is diagnose, prescribe, IQ test, implement. So what that means is that we use color-coded diagnoses in teaching tax flow based on your marginal tax rate. We teach people that marginal tax rate is more important than your tax bracket. We diagnose using color-coded diagnoses. Just like in the real estate market, you have A class, B class, C class, right? When you're in that world, you know what that means. So we use red, green, purple, gold based on your marginal tax rate. And then we prescribe a tax strategy based on your diagnosis. And then we have something proprietary we call the IQ test, which stands for identify, strategy, quantify, resolve. Because we want to make sure that the strategy you implement has you're comfortable with it, you have the liquidity, you're qualified, and it has a positive tax influence. I'll give you an example. How many times do CPAs that, people ask their CPA or tax professional, hey, do I get a deduction if I donate $1,000 to my church or synagogue? Yes, you get a deduction, and thank goodness that you're benevolent. But the tax benefit's probably 20%. So what teaching tax flow teaches is that you give $1,000, you get a 20% tax reduction. So you're still minus $800. You should still be benevolent, but those are some of the things that we teach. It has to pass our IQ test, and then we implement. And there's a lot of taxpayers out there that we talk about. So one of the other laws is that tax agencies are your involuntary business partner. So Pete, the IRS is your business partner. They're my business partner. If you're listening to this in California, you have another big business partner, the state of California.
Yeah.
So your business partner and you are in a partnership. You're not an LLC, but you're a partnership. And your business partner right now is picking your tax unless you do the proper planning. If you do the proper planning, you pick your tax. And that's what we teach. We teach people how to do that. And we have obviously several different paths for them.
So Chris, in your experience, what are some of the common tax strategies that people have used to lower their tax basis?
Well, so the common ones, aren't my favorite, by the way. The most common ones is to put money into a 401k.
Right?
Yeah, but we teach that now that if you're high red diagnosis, then it might make sense. But we teach people the difference between tax-free and tax deferred. And the most common mistake I see is that people getting started that are in a real low marginal tax rate that put money tax deferred. And now that you know this, Pete, when you first start working at a big company, the HR person says, put money in your retirement plan, which is not a bad move. But now look at the marginal tax rate you're in when you retire now, when you want to start enjoying that money versus then. If they would have said, put money into the Roth portion of your 401k, you would have all that tax free. So those are just some of the common ones. Let's just talk about the listener group for NARPM. Many of the clients that I work with that are NARPM members and people in their network own real estate. So one of the most common would be a cost segregation study on any real estate that they own. That's a very common one. 90% of CPAs and tax professionals don't know what a cost segregation study is, or they wouldn't know how to handle that.
Right. Okay.
Which is, and luckily within teaching tax flow, if you have again, teaching tax flow is meant to complement, not replace your tax preparation. So, but if you do have a tax professional that might not understand what a cost segregation is, we have what we call teaching tax flow black belts. We have other tax professionals in our network that we've trained to know how to handle that. So that's one of them, Pete. The other one, income shifting to related business entities. So let's say you do own that rental property and you can pay yourself rent legally and ethically. There are so many cool strategies we can use, especially as we see not only in property management, but in the CPA world, where we have multi-generational families or people selling their businesses. As you know, capital gains is taxed a lot less than ordinary income. So with capital gains, that's taxed at a lower rate, and you can invest that in opportunity zone funds. And then finally, for NARPM people, the 1031 exchange is another one that's used quite often.
Yeah, or just buy a big truck. Right.
So bonus depreciation. Yeah. You must have been taking our teaching tax flow courses, Pete. But yeah,
I just had many conversations with you, buddy.
Yeah. So buying fixed assets with bonus depreciation. Remember, the tax agencies are involuntary business partner. There are what we teach, and you're going to learn in teaching tax flow is that some behaviors are encouraged, some are discouraged. So that's once you understand how the tax laws are written, and we've broken these into really bite-sized chunks, you're going to know what actions to take.
So as a property manager or owning a property manager firm, right? We have lots of investor clients, and we always like referring our clients out to, do you know an insurance guy? Right. And so we have our network of people. So how can property managers show this service or use this as a tool in their toolbox to give to their investor clients or even non-investor clients? And then how can they use the service for themselves? Like, talk a little bit.
Right. So we have a partners program, and the one that I think would called our ambassadors program. And So the ambassadors program is set up for business owners or influencers that believe in our brand, that want to share it with their network of people. And with the ambassador program, typically we're going to set up a URL for them. There'll be some revenue sharing for that ambassador, and we're going to highlight the courses or the mini lessons or the content that's specifically for their customers. What I run into a lot is, especially with our NARPM friends, is that a lot of times, and you could speak to this better than I can, when you have someone that's starting to buy some properties, they're worried about their tax situation. They don't know what to do. They think it's going to get so complicated, and
typically what happens is they outgrow their CPA. Right. Like before I had my properties, I had a CPA or like an accounting person. And when I had a W-2 income and not much else, it was super simple to do even H&R Block can do it at that point. But as soon as I bought my properties, I realized that I kind of outgrew the person that I had, and I had to go find somebody that was real estate specific. Is that what you find as well?
Absolutely. And so there's this huge gap between the people that either do their tax return themselves or they go to a lower cost provider. But if they want to start doing business with a firm that has the knowledge that Teaching Tax Flow is going to share with you, it's going to be at least $5,000. So this is a great spot as far as the ambassador program for NARPM members that want to provide some opportunity for their owners that they're working with to learn. We have special courses on short-term rental properties versus long-term rental properties versus, like I said, cost seg, 1031 exchange, rep status, material participation, all these buzzwords that they keep hearing that they either have to, that they're kind of stuck and they want to make, so it's really there to help support them and teach people the benefits. I talked about tax agencies or involuntary business partner. There are a handful of industries that are tax advantaged. Real estate is in the top 3. So that tells us that the tax code tells us that investing in real estate has tax advantages. You're taxed on your net income. You get the depreciation deduction. And when we can share that with the NARPM members to be able to share with their owners, that adds value for them.
All right, Chris, we're going to be right back. We got a quick commercial, and then we're going to come back with the lightning round.
All right.
Lightning round? A little nervous, I bet. We'll be right back, everybody. All right, welcome back, everybody, for the lightning round. All right, Chris, we're going to ask you a series of questions. Answer them quickly. If you do want to expand, go for it. But let's rapid fire these bad boys. You ready?
Let's go.
What is one thing that most people do not know about you? Rapid fire, Chris.
That I'm an accountant, believe it or not.
Believe it or not, really? All right.
Well, most people that meet me think, are you sure you're an accountant? I'm like, you seem like you're a firefighter or police officer. I don't know if that's a compliment or what, but
I
think it's a compliment.
What Marvel or DC character do you most associate with?
Superman.
All right. What is your ideal vacation?
Spending time with my family at our vacation home in Florida.
What is one piece of advice you'd give someone just starting out in business?
Your network is your net worth. I know it's a cliche, but build out what we call your board of directors and focus on relationships and don't focus on sales.
Does pineapple belong on pizza?
Absolutely not. That's disgusting.
What book are you currently reading, or what is one that you could recommend that has impacted your business or life?
Yeah. Expert Secrets, just finished it. I highly recommend it.
Other than a NARPM podcast, what's another podcast that you recommend? Could be fun or business. Any
There's
podcast.
only one, Teaching Tax Flow.
There you go.
Check us out on everywhere you get your podcasts. Or Locked On Spartans if you're a Michigan State fan like me. Maybe that's the thing that people don't know about me. So,
all right. What is one challenge you're currently facing in your business?
Training our staff and attracting young people in our profession.
What is the average age of an accountant these days?
Oh gosh. I mean, the average age, there's some demographics. The average age of a CPA is about 50 years old. And it's really scary.
property managers are about 50 years old too.
Yeah.
Yeah.
It's real scary. And one of mine, it's scary, and I'm doing my best to get involved with the emerging professional networks in my home state of Tennessee and back in where I'm originally from in Michigan. So we need more young people that want to be CPAs.
All right. What do you prefer, dogs or cats?
Dogs.
All right, Chris, if someone is interested in becoming an ambassador or creating content, or, want to get a affiliate link or to get to their network to help, also like do a lunch and learn with you on this stuff for their network of individuals, what's the best way to do it?
Simply go to teachingtaxflow.com/partners.
All right. And then any email or phone number that they should know? Or is that the best way, the website?
Oh, I mean, hello@teachingtaxflow.com is probably the best way. We're on, and then the cool thing is or find us we have the podcast. We're all over social media as well. But hello@teachingtaxflow.com. We, as you know, we take a lot of pride in returning all communications within one business day.
And if you are listening to this and you are not a NARPM member, but you do want to join because you get to meet cool people like me and Chris, go to narpm.org, NARPM.org, or you can call them at 800-782-3452. And if you are looking for a virtual team member, remote team member, international team member, however you want to call it, or a virtual assistant, please go to my website, VPM Solutions, VPM Virtual Property Management Solutions.com, or shoot me an email at pete@vpmsolutions.com. Thanks, Chris, for being here. Thank you, everybody, for listening. We'll see you next time.
Thank you so much. And it was an honor to be here.